under the paper discussion of the December 2021, which is SL3, which is your corporate taxation, then let me come to the rest of the parts of the questions discussion, which is today I am starting with your one of the more or less interesting question, which is the company taxation question, which is in the section 2. In that section 2, question 3, which is awarded 30 marks for your calculation. Then it's 30 marks with reference to the resident company taxation, and it is in if I have taken the inclusion, it is from the assessable income, which is on the business and investment, and after that taking the taxable income, and this with reference to business and investment income, you need to take the liable income, exempt income, and particular concessions available, which are reference to the maybe it's applicable the second schedule, sixth schedule, and likewise, and the application of the first schedule for the income tax rates and tax credits, and this is amalgamating all these, which is your key component of your syllabus, which goes to the 30% of the resident company taxation, as it is for the 30 marks, it's testing. Okay, this is the discussion I am starting today, and in here what you all know, this is based on the pre-scene, a pre-scene issue prior to the examination. Then you should need to familiarize with the pre-scene, not only last time, this time also the same. Then therefore, the pre-scene will be issued before your July examination. Then you should need to be familiarized with the pre-scene and pre-scene analysis things, and after that it's unseen for the 30 marks. Okay, 30 marks mean it is the time you should need to manage, and entirely calculation based. Then your pre-seen knowledge and the reading the unseen very carefully and do the correction. This is one of the the student side, it's a good question for you all to attempt. Okay, then come to here in this paper discussion. Then let me come to what is the question, which is in the question 3, which is based on the pre-scene. Let me go step by step on this. Then computation of its requirement is in the part A, which is the computation of balance tax payable by resident company, which is the, you can see year of assessment is 2021, but for you now year of assessment is 21-22 for the July exam. Then not all but relevant adjustments, which with the amendments I have I will take into consideration when discussing the answer. Okay, that's on this. Then let me come to the next one. This is on the, let me come to first part first, and after that I will do gradually rest of the part. Okay, then this is based on the pre-scene now. Then let me come to your last time the pre-scene. This is your last time pre-scene Lamai. Then it is the equipped office solutions. This is common pre-scene for the all 4 subjects for December 2021. Then for the, this is the pre-scene. The company, your company is Equipped Office Solution Private Limited. Okay, then before go for the facts of the unseen, to me to start the discussion of the question and answer, then let me come to the analysis of the pre-scene little bit, not all, analysis of the pre-scene little bit for you to take some decisions with reference to the application of the application to the unseen. Then it's good if you know these things. Then let me come to that part also. This is the pre-scene which is for you to in the for December 2021, which is Equipped Office Solutions Private Limited, EOSL. Then here, this is what kind of the organization, the name of the company, it's in the short form EOSL, and nature and principal business activity, which is in any pre-scene before the exam. This is one of the key you should know with reference to the taxation lamai. Why? What's the reason? Because based on the nature or other principal business activity, you should need to apply the correct income tax rate, and to identify what kind of the expenses should be deductible, what should be disallowed, whether this expense is relevant or not. Then all the things depends on the nature of the business. Then come to the nature of the business. It is the providing of office equipment solutions. In the page 7 of the pre-scene, the nature of the business has elaborated. It is EOSL is the holding company. Now you can see these are very critical things, which is it's a holding company. You can see in latter part of our discussion the group structure, then holding company, and it is holding company of the equipped group of companies, and EOSL is a specialized imaging and the printing company with the portfolio that includes copiers, printers, the multifunction units, and the production of the graphic arts machine, and all these things are there under the world famous brand of the products. That means they are in one roof. They are in the providing office equipment solutions, printing solutions with reference to the one roof. Then under the one roof they have many categories of the branded products. The company also provides a range of service products such as outsourced printing services and customized layout and designing services at its print hub center. Now not only the selling of the office equipment solutions, also they are providing a printing kind of the printing services. Okay, then these are the main kinds of the nature of the business activities. For you to apply the income tax rates, take into the consideration of the relevant expenses, disallowable expenses, identify the income effectively connected to the business. For all these things, the nature of the business is really important. Now what's their sector? The sector is very important. Again, based on the nature of the business, you need to categorize the sector. Why sector is important, Lamai? Because now we have the industry specified tax rates, the reduced tax rates applicable to the particular industry. Then therefore, to that we should, for us to identify whether what kind of the tax rate we should need to apply, then the particular sector, whether it is a manufacturing sector, whether it is a service sector, or else whether it is the buying and selling, import and selling, the whatever the kind, we need to identify. Then the sector, the company EOSL is acting as a distributor, seller of office equipment solutions and providing of the service relevant to the printing. Then more or less as the distributor, which is in the retail or distribution sector, and the in the providing of the services in one category. Okay, the two main income sources we can see. Okay, then date of incorporation 1966, it's for your information, and this is the product portfolio and the percentage of the revenue. These are very important to know again the nature of the business. They are having the photocopier business for the 40%, printers, multifunctioning machinery and the services 20%, the digital, the duplicators 5%, larger format printers and the production machines, the print things, it's a 5%. Then it is outsource operations, which is rental business. You can see outsource operations, rental business is a part and partial of their income, the 5%. Then if there is a rental income, you need to look at how it has generated. Then air conditioners 10%, then IT related products, desktop, laptop, that particular services is a 15%. This is the percentage of the revenue in the company. Okay, then next one, which is a very important, the group structure, which is subsidiaries. It is EOSL, which are a concerned company, which is parent. It is in the imaging and the printing company. then it has, you can see the 3 wholly owned subsidiaries and again a subsidiary called HTL. Now can you see what my industry? I am in the distribution industry, and being in the distribution industry, then I have 3 wholly owned subsidiary and 180% owned another company. Then what is the advantage of knowing this to application of the income tax rate? Then can we apply the income tax rate of the 14% in any, this is not relevant to any of the reduced industry which categorize under reduced tax rate? No. Then being a small and medium enterprise, no way, we cannot apply. Then after that, what's the tax rate? Is a normal tax rate. Now normal tax rate we should need to apply. For that understanding we need to take from this, knowing these things. Okay, then this is the group structure, or the subsidiaries which EOSL has done. Then this is on the shareholding structure. It's an individual shareholders and the stated capital, what's the number, and this is what I need to come income tax rates in the, because before applying the income tax rate I need to come to this. Income tax rate is the 24% on the business income. It is the first schedule para 41B. Then why normal tax rate, which I have explained, it's not engaging in the business where the reduced tax rates apply. No any reduced tax rate apply. Then shall apply only the shall not apply the 14% on the small and medium enterprise. Lama, you can see anyway this is not the small and medium enterprise. Okay. Then the next one, it is but it's totally based on the pre-seen information, but you need to know unseen, whatever the change happen you need to apply that. But let me come to this one, which it's a business income. Now you know it's 24%. Investment income, it's subject to whatever the exemptions, and business income also subject to whatever the exemption, and investment income is 24% you have to go. If there is a gain from realization of investment asset, this is again subject to exemptions, the 10%, and anyway the gains and profit from the dividend, it's a 14%. Now this is for you to just to highlight the relevant tax rates and how you all come into the application of the relevant tax rate. Then that's all for me to take from the pre-seen information. Now directly let me come to the discussion of the question, and like in the usual, let me discuss the question and each relevant adjustments I will explain, and directly I am coming to the answer, and likewise a question, a particular adjustment, and the answer I will do. Okay. Then come to the question. Let me come to the requirement first. In the requirement for your 30 marks, then Lama, it's a 30 marks, it's a 1.8 minutes, then 54 minutes you need to spend, not more than that. Then required, assess the balance income tax payable or refund due, if any, by or to EOSL, Equipped Office Solutions, in respect to year of assessment 21-22. Lama, what I am doing for this 2021, there are changes to 21-22. Then I have taken that changes together. Then I will explain those. Then my answer, it is with reference to matching for the year of assessment 21-22, not for 2021. Then I think I should have to do like that. Then it is even the year of assessment 2021, my answer I have adjusted to your testable year of assessment, which is 21-22. Okay, then this is a requirement, and let me come to the adjustments. Meanwhile, if required, I am referring to the pre-seen also. Then this is question 3 based on the common pre-seen. In addition to the information provided in the common pre-seen in relation to Equipped Office Solutions Private Limited, you are provided with the following additional information for the year ended 31st March 2021. The detailed unaudited income statement of EOSL for the year ended 31st March 2021 is as follows. Now the revenue, there is a note, cost of sales, gross profit, it is in rupees, you can see, yeah, it's rupees 1000 and the 1000 millions, and the gross profit, other income, there is a note, administrative expenses, there is a note, selling and distribution, other operating expenses for all, there is a note 3. Results from operating activities, the finance expense and the finance income, which we need to look at what is a finance expense, what is the inclusions, and what is the finance income for us to identify relevant to the business and relevant to the, it's a investment or whatever is effectively connected or not. And the with reference to other income also the same, the net finance cost, profit before tax. This is the key thing which you start in figure in your the business income computation. This is a starting figure, profit before tax 210, 116. I am starting from that, which is in the answer. In the, I think I need to come for these things. It's December 2021 question 1 part. I am highly telling for y'all, before the question is starting, please have this complete format, whatever the format. I'm not telling you should adhere to these formats, no, then whatever the convenience to you and whatever the convenience, that means to clear answer script, you need to follow these things. And it's a computation of the income tax liability, which is Equipped Office Solutions Private Limited, EOSL, the TIN number, computation of income tax liability for the year of assessment. I have taken it as a 21-22, even it has given in the question for 2021, it's a red color I have given, change the year of assessment for the current testable year of assessment, but not all, but relevant things I have done in the answer. And this assessable income and this business investment, for these format, please, you know these things, the total assessable income and deductions from assessable income, taxable income, tax on taxable income, and finally tax credit. Lamai, please go through. That's mean before the starting the question, I'm telling how this formats. It's easy for you to without missing any adjustment. You can put in the adjustment in one time when reading the particular adjustment. If not, it's taken much time. Okay, for doing this, for one of the reason, the patricing, this is a calculation question, you should need to patrice this very carefully, and within a less time you have to do this, not taking much time. It's a 54 minutes. Then if you have patrice, you can do it very quickly. Then this is on the business income. These headings, anyway, it's not much required, but at least schedule 1 computation of the assessable income from business, or a schedule 1 computation of business income, that's all. Then I'm starting from the net profit before tax, which is in the unseen question, which is 210, 116. It's a rupees 1000. Okay. Now, first thing I have taken, this is your starting figure. Done. Then after that, what we have to do, I'm starting from the adjustments. I'm starting from the adjustment while explaining the rest of the part. Come to here, then income tax reversal, this profit before after tax, which is on the other part, I'm not considering. Then for revenue, we have equipment sales, we have consumable sales, we have the service revenue as given in the pre-scene. It's the same set of the sub revenue lines. Then the other income, we have rental income or rent income, dividend income, profit from sale of fixed assets, foreign service income, we have gain on sale of shares quoted in the Colombo Stock Exchange. This is one of the exempted source which should categorize under investment income, and we need to look at these any sub notes. I'm not coming to these areas now. Then extracts of the certain expenses recorded under administrative, selling and distribution and other operating expenses, remuneration, director fee, provision for retirement benefit obligation, one of the disallowable expenses, bad and doubtful debts. We need to look at whatever the clarifications given. provision for impairment of slow moving consumables and damaged stock is a provision, should be disallowed. CSR expenses, kind of the donation, then this need to be disallowed, but we need to check the nature of the donation and or CSR expenses. We need to look at the can we take the qualifying payment under section 52 and the 5th schedule. Then warranty provision, again it's a provision, it should be disallowed. Depreciation and amortization, typically it's for the property, plant and equipment and intangible asset 210 million, this should be disallowed. And right of use asset, it should be disallowed. Then fines and penalties, we need to look at what's the nature, anyway disallowed. Legal fee, we need to look at the nature. Advertising and promotion, we need to look at the nature. Stamp duty, we need to look at the nature. Consultancy fee also same. Repair and improvements, need to look at. Office maintenance and staff welfare, all these things we need to look at. If there are adjustments, we need to go for that and do the adjustments. Then finance expense, interest on loans, overdraft interest, lease interest on right of use lease asset, this should be disallowed. Bank charges, anyway it's allowable deduction. Then we need to look at that interest on loan and the overdraft interest, these two. Whether it's incurred for the production of income or not. I will explain the application of the deductible amount of the finance cost with reference to the 21-22. Okay. Then the finance income, interest on debentures and the fixed deposit interest, more or less investment income. We need to remove this from the profit before tax. Okay. Now come to Roman II adjustment. Details of the assets acquired during the year of assessment 2021. I will take this for 21-22 are as follows. And I'm starting from here because the adjustments starting from here. I'm taking this as the first one. The additions during the year. For this, what you need to do, you need to provide what? Capital allowances. Then land, are you providing capital allowances? No. The land is not a depreciable asset, but land is what, Lamai? Land is a capital asset of a business. Then the land is not a depreciable asset and it has indefinite useful lifetime, no capital allowances. Then building, which is it's a 1 million. Then for this building, we need to provide the capital allowances, the number of years 20. Then motor lorry, the number of years 5. Forklift machine, number of years 5. Office equipment, number of years 5. Computers, again number of years 5. And the capital work in progress building, no, this is not a depreciable asset. To be a depreciable asset, it should be owned and used asset. Own mean it's for the under the name of the company. Use mean it should be used for the production of income. Being a work in progress, then it's not the completed one, then it is not the use for the particular income generation for the production of income of this distribution or a service sector. Okay. Then this is on that explanation. Let me come to the answer, which is the here the capital allowances on assets acquired during the year. Land, it's not a depreciable asset, not eligible for the capital allowances, not given. Building, which is class 4 asset category, it's a 20 years, the 1000 divided by 20. Then the classes I have given for your explanation. Then the motor lorry, it's a class 2 asset category, then it's 5 years. Then it is there are many motor lorries. I think it's a 93 138. Then the next one is a forklift machine. The class 3 asset category. It's a 5 years. We should need to provide the capital allowances provided. Office equipment, class 3 asset category. It's a 5 years. Then it's a the 14,100 divided by 5. The computers, which is class 1 asset category, it's a 5 years. We can provide the capital allowances. Then it is 460. It's in the computers 2,300. Then here, if I have taken the same thing, 2,300 divided by 5 years, then it's 460. Okay. then yeah, 2300 divided by 5, done. Then this is on the capital allowances, done. Then capital work in progress building, not a depreciable asset, therefore it is not eligible for the capital allowances. These things, when you are writing the explanations, please write these things. It's important for you to take then the marker know, you all know these things, okay. Now these are the capital allowances. Then let me come to the next part, which is the Roman 3. The depreciation allowances claim for the year of assessment 1920 was rupees 143,435. None of the assets reached their fully tax depreciated levels in year of assessment 1920. That's mean even for a 2021 the same capital or a depreciation allowances with reference to opening assets which acquired prior to this year of assessment, then for same capital allowances or rather depreciation allowances we can use, then therefore 143,435 the same capital allowances on the opening depreciable assets, then it is a deductible amount under the section 16 and with reference to the 4th schedule, then that also completed. Then this on the adjustments relevant to the capital allowances, okay. These are all the parts we have completed now. Now come to the next adjustment in the paper, which is adjustment 4. Rent income represents the income received for renting out the ground floor of the office building to a third party and the cost of reimbursement from intercompanies. Now rent income, it is, now you can see in the even in the pre-scene it has given rent income as a part of the income, and in the paper rent income has recognized under the other income 90 million. Now you need to look at what is the nature of the rent income, whether this is investment income, and do we need to remove this from the business income and categorize under section 7 under investment income, or else under section 6 subsection 2 whether this is effectively connected to the business. Now you have to take that decision. Now how to take that decision? It's taken based on the information provided in the adjustment. What's the information provided in the adjustment, Lamai? It has given how rent income is receiving. The rent income is receiving renting out the ground floor of what building? Office building. Then we have our office building. By letting of that office building, then we are receiving the rental income one part. Is it a letting of a idle building? No. Is it letting of the idle land or a bare land which not used for the business? No. This is a letting of the office building. Then this is effectively connected to the business. The office building is not an investment asset. If the rent income is recognized through the investment asset, yes, it is an investment income. But this is the office building which is a depreciable asset, then which is from that there may be additional space, then we have rented that area, then from that we are receiving a rental income, Lamai. Then this is effectively connected to the business and it is part of the business income. I am not talking about how it's removing and this is the answer, not, but how you are recognizing whether this is a business income or whether this is investment income. It's very critical for you to, by knowing the definition of the depreciable asset, definition of the investment asset with link to the capital assets, like that, okay. Then next one, to the other part of the rent income, to the ground floor, to the third party, and the cost of the reimbursement from the intercompany. Anyway, the cost of the reimbursement of the intercompany, it's also effectively connected to the business, Lamai. Then entire rental income which is in here which is rupees 90,000, it's effectively connected to the business. This is effectively connected to the business. Then therefore no adjustments required, but you have to write that. Come to here, which is rent income as per information provided, effectively connected to the business under section 6 subsection 2, then no adjustments required, no adjustment required. Okay, done. I have explained as per information how you are taken the answer. Then let me come to the next adjustment, which is on adjustment 5. The company received dividend income of rupees 68 million from ECPL and ECL. Now we have two subsidiaries, 100%, that means wholly owned subsidiaries, ECPL and ECL. Then from that the Equity Office Solutions, we have invested in these two companies in fully. Then therefore we are the shareholders of these two companies. Then 68 million we have received the dividend income. We can see where it has mentioned. It has mentioned in the dividend income, which is 68 million sharp. Then for this is not form part of the business income. This should be part and parcel of the investment income. Let me come to here. Dividend income, this is part of the investment income. Total dividend income I have removed from the business income because it has included in the PBT. Then I need to remove it from the PBT. Then I have done it in the same manner. I am coming to the investment income, then I am recognizing this under investment income, the schedule 2 computation of assessable income from investment. It's again it's 1,000, and the particular thing which is in a relevant manner I have taken into the 21-22 year of assessment. Then the dividend income. Now Lamma, you may have a question whether this dividend income, because in the question silence එක ගන්න පුළුවන් කෙලින්ම it's a liable dividend කියලා, but it's good to put the assumption, assume that total dividend income consists the liable dividend income. The liable dividends is there, then therefore you can take like this, and after that you can take it under the investment income. It's considering as the liable dividends. Okay, no exempted dividends. It's not given even in the paper, but good to write this and take your answer. Then that entire part completed. Now let me come to the next adjustment. What is the next adjustment? Then this is the EOSL sold the lorry and some equipment during the year of assessment. The total sale price of the said assets, that means two assets lamai, lorry and some of the equipment. For both of these two assets, there is a consideration rupees 33,450,000. Don't forget, this is for entire these two assets. Then details of the assets are as follows. Now if there is a asset disposal, these are two depreciable assets. What you need to do, you need to compute the whether this from this disposal, whether there is a balance in allowance or else whether there is an assessable charge. Then under the balance in allowance under section 16, it should be deductible. If there is an assessable charge in under section 6 subsection 2, it should be added to the when computing the assessable income from business. Okay. Then motor lorry, it has purchased in 2014-15, which is the cost 50,500. Equipment 2015-16, 34,000. Now when looking at this, when you are reading the question, you need to take this understanding. Now this is lamai acquired prior to 1st April 2018. Then motor lorry, it's a 14-15. What's the capital allowance, or sorry, capital or rather depreciation allowance rate applicable at that time? It was for the motor lorry, any motor vehicle, it's a 20% other than the traveling purpose. Then equipment, it was 15-16, it was 33/1/3. Then you can see both of these two assets, what happened, these are fully capital allowances granted assets, or rather fully depreciated assets. then thereby the entire sale proceed is there to tax, then the total cost and the cumulative capital allowances claim is the same. And what the next adjustment, rather than computing taxable income and the there may be a balance in allowance, whatever I am commonly explaining. And what next, you need to look at whether there is a profit or loss. Now you can see in the other income there is accounting profit on sale of fixed assets, 31,965,000. Can we keep this under business income? No, Lamai. You need to remove this from the business income. Come to here. Here we go. Profit on disposal of fixed assets. Then it's 31,965. It should be removed from the profit before tax. In this PBT, it has included since it's a profit. Then when arrive into business income, I have removed it. Now let me come to next tax adjustment on the disposal of the depreciable asset. We need to compute assessable charge or a profit on the disposal of the depreciable asset. I am coming to work in one. Here, come to work in one. Then it's let me increase little bit for you to okay. Then workings for business income. In that work in one, what's the work in one? Computation of assessable charge or tax profit on disposal of depreciable asset. The disposal of motor lorry and equipment, both I have taken together. Why? It is one selling price is there. Consideration for the both assets as given in the paper 33,450. It is given in the adjustment 5. Then it's adjustment 633,450. This is there. Then it's a lorry equipment. We need to compute the tax written down value separately. Then this is cost 50,500 for the lorry. Cost of the equipment 35. And you can see less cumulative capital allowances claim. This is capital allowances fully granted, Lamai. Therefore, total cost equal to the capital allowances. Then the tax written down value is 0. Then assessable charge 33,000. The 450, the same sale proceed is considering as the assessable charge. It is assessable charge or rather tax profit on the disposal. Therefore, it should be part of the business income under section 6 subsection 2. Then 33,450. This is the answer. That's one also completed. Okay. Now come to next adjustment, which is in the 7th one. During the year of assessment, the company was able to earn service income. One of the key revenue line, service income of rupees 22,300 in respect of providing remote technical support services to a company in Maldives. This is remote technical service. That means we have not in Sri Lanka, and we were in Sri Lanka and provided these services to Maldives. The income is received to EOSL's bank account in foreign currency, and it has given the profit of the project is, that means this the technical project of the providing of remote technical support services to Maldives. Then for this, the profit of the project is rupees 5,575,000. Now, what's your adjustment? What's your adjustment? Now, my first thing, you need to look at where this has, what the figure is, 22,300 or 5,575 is a profit, whether it is included in your profit before tax. That's the first thing. No? Then let me come to here in the income. It's a revenue in the main, there is a service revenue, but no details given on the here. But in the other income, you can see the foreign service income rupees 22,300. It has given rupees 22,300. It has given. Now, what the tax adjustment you have to do? Then for that you have to read this carefully, Lamai. This is what service income received from foreign currency by providing a service to the person outside Sri Lanka, which is Maldives, person outside Sri Lanka, and utilize outside Sri Lanka. The who is the beneficial party from providing that remote technical support service? It's a Maldives company. Then utilize outside Sri Lanka, and how, what's the way of receiving of this income? It has remitted to the bank in the EOSL in foreign currency. Then this is what? This is exempted income, and this is exempted income 22.3. we need to remove from the it has included in the other income. Then we need to remove it from the other income. Why we are removing it? Because Lamai, this is not the liable business income. This income should be the exempted income. Then let me do it first. Come to here. Then it is a profit, sorry, it should not be the profit, it should be first income. Income from providing of foreign services. It's a exempt under third schedule, paragraph U, subparagraph Roman 3. Anyhow the exemption has worded, any service rendered in or outside Sri Lanka to any person to be utilized outside Sri Lanka, where the payment for such service is received in foreign currency and remitted through a bank to Sri Lanka. The exemption is applicable on or after 1st January 2020. Then typically exemption is applicable. Then it is the technical service, and it's outside Sri Lanka, and any person to be utilized outside Sri Lanka. The Maldives company, it has utilized outside Sri Lanka. Then entire that service fee, let me remove it from the business income because it is exempted. Now there is a hidden thing, Lamai. In the adjustments you can see it has given in the paper, in the adjustments it has given what? It's the profit of the project from this providing remote technical support. The profit from the project is rupees 5,575,000. Now what has happened? The profit given, but in the service fee income it has in the other income. Profit given, but none of the places in the question given in this income statement and all, that it has not provided the profit has included in the profit before tax and whatever, it has not given, but foreign service income given. Now, now Lamai, in the question the income has given and in the adjustment profit has given. What's the indirect thing you can see? There are expenses which incurred to earn this foreign income. I think you got the point. Now the income given, it has included in the other income, and Lamai, profit from this project has given. What's the indirect meaning of this? There are expenses, but can it be visible here? No. The particular in the note number 3, they're given in the expenses, but it has not visible. But we cannot only remove the 22,300 because the profit has given. Then what we need to do, if we have removed the exempted income, the expenses relevant to that exempted income we need to add back. Api exempted income එක tax කරන්න වගේම ඒකට relevant expenses අපිට අඩු කරන්න බෑ. Then that's why I have taken the cost relevant to exempt income with the assumption that incurred or included in the expenses when arriving into PBT, this expenditure I have assume that it has deducted already. That's why the profit component has given, but in the given income statement, the none of the that profit has included or not, it has not given, but indirectly we can identify there is a cost. Then cost is 16,725. How can I arrive to 16,275? It's the income 22,300, and Lamai in the paper it has given in the adjustment there is a profit 5,575. The profit 5,575, then therefore it is 16,725. You can see this expenditure. Then automatically the income is more, cost is less, there is a profit. The profit has removed automatically, but since the profit has it's included or not included, no details given in a reasonable manner, I have adjusted like this. Okay. Then this is that adjustment. Now you can see in the business income not only the liable income but also exempted as usual in the previously it has attested. Then please ready for this kind of the adjustments done. Then that entire part I have completed. Now come to next one, adjustment 8, which is the bad debt includes bad and doubtful debts include the bad debt written off amounting to rupees 8.2 million. Now bad debts where it has included in the note number 3, bad and doubtful debts, the total it has given 27,500. Bad and doubtful debts, it's given 27,500. Now from that 8,200 it's for the bad and doubtful debt written off. Sorry, it's a bad debt written off. Then what's the reason to written off the bad debts? And the balance amount related to the provision made for the debtors exceeding the credit period of 183 days. Now 27,500, one component goes to the written off, other component is very typically given, it's applicable for provision Lamai. Any provision under section 10 subsection 2b Roman 8 it should be disallowed. Then with reference to this 8,200 I am again looking for adequate action has been taken to recover debts before they considered as the bad debts. This is talking about this 8,200 which is the bad debt written off, which is the adequate legal actions has been taken to the debt recovery procedure. Then can we deduct this 8,200? Of course, yes, we can, but the provision we need to disallow. Bad debt written off, this is an allowable deduction. Why? The relevant action, that means debt recovery action obtained to collect debt, then no adjustments required. It's already deducted from the PBT, then it's an allowable deduction even due to taken the necessary legal actions and all recovery action. Then provision for bad debt, it should be disallowed. Why? Under section 10 it's talking about the disallowable expenses when arriving to person's income. Then under section 10 subsection 1b Roman 8 it's a total amount under administrative expenses 27,500. We need to remove the bad debts write off which has already included in there, which is an allowable deduction. Then 19,300, which 27,500 minus 8,200. This is which is the provision for the bad debts which should be disallowable. Okay, then that's on the disallowable expenses with reference to the bad and doubtful debts done. Then the next one, please for the bad debts written off, please look at what the company has done before the written off of the bad and doubtful bad debts, proper legal action taken, debt recovery action taken, what's the things they have done, are they still doing the transaction with these people, then these things you need to look at. Then the ninth adjustment, CSR expenses relate to a donation made to the Ministry of Health for the purpose of purchasing some medical equipment. Now it's a CSR, there was a 4,300. It's a donation made to the Ministry of Health. That's mean what, lamai? This is a donation to the government under section 52 with reference to the 5th schedule. Then it is donation to the government in any kind. We can take it as the any kind, that's mean in money or by way of the goods. Then this is applicable up to the, we can claim up to the as the qualifying payment, we can claim this up to the assessable income. But when arriving into business income, what you should need to do? It should be disallowable. Why? This is not incurred for the production of income. The CSR expenses, it should be disallowed. Why? It has not incurred for the production of income. Then 4,300 you need to disallow. In the same manner, lamai, I am coming to here. I am telling you to do the same thing then at your examination, because it is the for you to save your time, which since you have these formats. Then from the assessable income for the company, we can, there are deductions from the assessable income, in that the qualifying payment, then the qualifying payment is in the section 52 and the 5th schedule to the act. Then it's a donation to Ministry of Health. It's a, in other way, it's a donation to government, where it has mentioned in the 5th schedule, subparagraph the subparagraph 1, in that B, it is can claim up to the assessable income. Then for time being, I have put the 4,300 here. Then we can check it with the assessable income, more or less the assessable income is higher than this. Then this is 4,300 as the qualifying payment to the government I have taken. Okay. Then this is on that, the all two sides of the adjustments I have done. Now come to 10th adjustment, which is on the warranty provision, has been calculated based on past experience and the actual expense incurred as warranty claims during the year 15,750,000. Now any warranty provision, I think in the CSR activities I have not shown the amount. In the CSR activities, this is the expenditure 4,300, we have adjusted that. Now let me come to warranty provision, where it is, it's a warranty provision. Here we go. In the warranty provision, it's a 23,400. Any provision, lamai, it should be disallowed. Let me do it first. Warranty provision disallow in the same way, section 10 subsection 1b Roman 8, 23,400. Done. Then what the why in the paper it has given that actual warranty claim, that means for the customers what we have claimed as the warranty 15,750. lamai, this is actual utilization from the provision. The provision we have previously disallowed. From this there are actual utilization. This actual utilization, or rather incurred against the provision, actually this should be an allowable deduction. Then let me take this as the allowable deduction. This is the actual warranty expenses on claims which has done for the customers. It should be allowable deduction. Actual utilization, then it should be deductible. Let me do that. Then the entire that warranty adjustment under adjustment 10, it has completed. Now come to the 11th adjustment. The right of use lease asset and lease liability represent SL3 16 adjustment with respect to the lease agreement entered into with third party to use a warehouse building for a period of 10 years. It's a operating lease agreements. Then under the SL3 16, now what you have to do, sorry, the tax adjustments relevant to the SLFRS 16. Let me come to one by one. It has given in the finance cost, where it is here. In the finance cost, lease interest on the right of use lease asset, it should be disallowed. Don't look at the thing capitalization under section 18 or the section 12, whether it is allowable under that two situation under section 12 A and B. Don't look at these things. This should be disallowed. Okay. Then after that, any amortization with reference to write off, there is a 10 years, then in that the particular amortization, it should be disallowed. It's a notional entry, it's based on the standard we are doing. Then it's something for the future losses today we have booked, like a depreciation, the amortization, then it should be disallowed 4,945. Let me do that too. In here, amortization of ROUA, it should be disallowed under section 10, done. Then lease interest on the ROUA, don't allow, because we are allowing the rental. Rental has two components, one is the capital, other one is the interest. Then through the rentals we are allowing that particular interest also, then we disallow this interest expense which relevant for the year, then it should be disallowed. Now what's the next step which you have to do? We need to take the actual lease rental paid, or rather settlement of the liability, which is actual lease rental paid on the ROUA. Then we need to compute it based on the information provided. Where that information provided, it's provided in the pre-scene. Then computation of actual lease rentals paid on ROUA, the settlement of the lease liability. Now let me come to pre-scene financial position. In the pre-scene, in the financial position, this is the question. Let me come to pre-scene. Sorry. In the pre-scene, you can see in the annexures, where, okay, here. This is the income statement, this is the financial position. Now in the financial position, okay, you can see in the here in again it has, okay, then let me take to this side, equity and this liability side. You can see liabilities, lease liability, and the liability we need to divide into current component and the non-current component, and in the current liabilities there is a lease liability. Then we don't know now for the finance lease agreement entered or no after 1st April 2018 in the taxation, we have a different treatment. We are providing the capital allowances on those things. Then I have put the assumption that this entire lease liability, now in the asset side, it has recognized a right of use lease asset. Then for 21 and 22 for the company, the asset recognized and amortization done. That's part completed. Now in here, liability is given in the lease liability. Normally we need to take from the what's the settlement from the right of use asset, that particular rental payment during the year. Then for this I have put the assumption this lease liability represents only the right of use asset. That particular lease liability is only, not the finance lease, the particular details are not given. Then therefore the lease liability, I have put the assumption is totally consistent with the current and non-current both. It's with the operating lease agreement. Then assumption, it is assumed that total lease liability represented in the financial position, it assumed that total lease liability presented in the financial position, they represent the right of use asset liability on operating leases. Then no harm. Then I have taken the balance as at 1st April 2020 and balance as at 31st March 2021, which is short term and long term both total. In the settlement we need to take that both. then for 8,172 and the 11,300, and here 3,324 which is closing, and 11,292 මේ දෙක සහ මේ දෙක 3324 and the 2172. Okay, then this is the opening and this is the closing, opening minus closing, and after that interest expense on the, that it's a present value, we have to take the balance, then for that we have taken the interest expense, then that should be the add or the plus for this liability. Then actual rentals paid on ROUA on the, or the settlement of the liability on lease rentals paid, it's a 6,200, it is 6,200, then it is an allowable deduction. It is an allowable deduction. In the working 2 I have taken this. Okay, done. Then I think it's clear. Right of use asset, the it's a SLFRS, under the SLFRS 16, interest finance cost in the interest expense on the ROUA we need to disallow, amortization anyway disallow, actual lease rentals we need to allow. If it is not given, this is the way how you all computing that. Why the actual, this particular interest expense which we need to disallow, Lamai, because this rental payment, the rental has included 2 components. One is the capital in that rental and plus the interest. Then through the actual lease amount to allow, we are given the benefit of the interest also. Therefore, this finance cost we need to disallow. I think it's clear how I have taken and the assumption and everything. It's clearly elaborated. Now come to next adjustment. Again, I'm shifting to the question. Then, okay, it's a 12th adjustment, fines and penalties related to the payment made to the EPF and ETF and Inland Revenue Department for penalties for several late payments. Then for this, all the penalties and fines it's paid to the government, then this should be disallowed. Now, this is the adjustment where it has mentioned in the amount in the administration or that particular note 3, it has given the fines and penalties 2,300. Fines and penalties 2,300. For this, it should be disallowed. The fines and penalties it disallowed in section 10 subsection 1b Roman 3. The penalties, interest, fines is paid to the government on the breaching of the contracts, then breaching of the laws it has given, then it should be disallowed. Now what next adjustment? In the legal fees represent the payment made to the company lawyers for what the reason, the debt recovery cases, the debt recovery, what we are why we are doing so, to generate the production of income, then therefore it is an allowable deduction. Then where the legal expenses mentioned, it is legal fee rupees 450 total, it's a fully allowable expenditure. Legal expense allowable deduction incurred for the production of income, then it's a no adjustment required, the no adjustment required. Okay, that also done because it's incurred for the production of income. Then let me come to next one. In the paper, the next one, which is advertising and promotion expenses were incurred for promoting the company products on television, radio, newspaper and social media, the mass media and the social media, the advertising expenses. This is an allowable expenditure. Now I need to explain. Now under section 15 subsection A, section 15A, not subsection A, section 15A under marketing and communication expenses, this television, radio, newspaper and social media advertising, that marketing expenditure, anyway there is a separate provision we can deduct and it link with the double or It's a double deduction rule. It's linked with the 6th schedule under temporary concessions. Please go through these areas. And here we go. Advertising expenses, allowable deduction. It's incurred for the production of income. Done. This part completed. Sorry. This one also completed. Let me color those. If not, we are missing what to do, what we have to do. Okay. Then the next adjustment, which is stamp duty rupees 999,000 and valuation fee, which is included under consultancy fee rupees 550,000, were paid in relation to purchase of land. Lamai, these are the capital nature expenditure, the stamp duty and the valuation fee. Then both of these should be disallowable. Stamp duty in our note 3, stamp duty it is there 992, consultancy fee 950. Then under this, both incurred for the capital nature expenditure, which is on the purchase of the land. Then therefore from this 550 and 999 should be disallowed. Come to here. For that adjustment, stamp duty on valuation, which is in the capital nature expenditure 999, and the stamp duty on purchase of the land, which is both are in the capital nature expenditure, this should be disallowed. This should be disallowed. Okay. Then that part, 2 parts in the valuation fees and the stamp duty we have completed. It's a stamp duty 999, valuation fee, which is sorry, I have made a mistake. It's a stamp duty, not the stamp duty, it's on the valuation and the stamp duty, both it has there. The adjustment is clear. Then the next one, come to next one, which is rupees 4.3 million was incurred on a repair and improvement expense for the major modification to a building that was purchased during the year of assessment 1890. 1819 building has purchased at a cost of rupees 35 million, and for that repair has, it's a given repair and improvement, and it has the wording given major modification. Then this is a repair and improvement. Okay, we have to apply the section 14 of the Inland Revenue Act, but for 2021 the provision is different, and 21-22 the provision is different. Then I have adjusted the answer accordingly. Before anything, let me explain the current provision. That's mean the 2021 provision and what's the difference with the 2021 provision. Repair and improvement building, which is the asset purchase in 2018-19. Let me little bit increase this. Okay. Then here what has happened? Now you know section 14, it's a specific deduction rule. Then it has given prior to 1st April 2011, it has given repair and improvement both has addressed. But what happened after 1st April 2021, a change has happened. But prior to that, let me come to the according to the provision under prior to 1st April 2021, the provision of the repair and improvement prior to 1st April 2021. What is the cost of the asset? It's a 35 million. Now, what we need to do, Lamai, before the answer, what we need to do if there is a repair or improvement, if it has charged to the income statement, the first step, we need to look at what is the actual repair expenditure. And after that, in the second, we have to do the comparison. How to do the comparison? We need to take of this asset, the previous year tax written down value. We need to take the previous year's tax written down value. Now, from the previous year tax written down value, based on the class of the asset, based on the class of the asset, we need to check the 5% or the 20% based on the class of the asset on the previous year tax written down value. Then after that we need to compare it with the actual the actual repair and improvement cost. Actual repair and improvement cost, and if there is the actual cost is higher than 5% or 20% based on the class of the asset, then we need to disallow that excess, disallow the excess of the actual repair above the limit, and for that part we need to add it to the depreciation basis of the depreciable asset. Okay, now this is a treatment. What we have done. Clear? This is just a simple explanation on the section 14. Then under that, for this adjustment prior to 1st April 2021, then it is we need to take the prior year tax written down value. Now we are in a 2021, then what is the prior year? It is the 1920. Then in the prior year, what's the, that means 31st March 2020, what's the tax written down value, lamai? It has the 20 years we need to provide the capital allowance, then 1819 1750, 1920 also 1750. For the 2 years capital allowances claim, then tax written down value as at 31st March 2020, it is 31,500. From this we are in the class 4 asset category, which is building and the permanent structure. We need to take the 5% of the previous year's tax written down value, then maximum amount of repair expense applicable under the section which is section 14, then it is the 1,575. Let me take it here. Okay, then actual repair expenditure is a 4,300. There is a gap. Then this allowable repair cost, and which should be added to the depreciation basis, it is 2,725. Now this is the provision prior to 1st April 2021. This approach of the taking 5% or a 20% application, everything is same, but what happened? There is a definition change. That's what I need to elaborate. Definition change. What's the definition? This is the answer based on the IRA provision on or after 1st April 2021. Let me come to definition. This is a major change happen, lamai. Definition of improvement under section 14 on or after 1st April 2021. This is the definition of the improvement. Improvement means the expenditure incurred by a person to make additions or alterations to a depreciable asset which enhances the value of such asset. But it's what has given, it excludes the expenditure incurred to maintain or repair a depreciable asset which temporarily enhances the value of such asset. Then I think you can see this. From the definition of the improvement on or after 1st April 2021, the repair has excluded. The repair has excluded, therefore even the provision is the repair and improvement. Even the provision is the repair and improvement. Then the question is the repair has excluded from this definition after 1st April 2021. Then adoption to this answer, this question, come to my explanation. Now this is the change. I have taken prior provision Now I have taken the current provision which will be applicable from the year of assessment 21-22. Now let me come to the elaboration of the answer. Above adjustment only applicable for improvements. Then now it's a not repair. Then api make nama repair and improvement tibunata, but with after 1st April 2021 it was from the improvements. If the repair expenses satisfy the main deduction rule, which is section level, which is incurred for the production of income other than capital nature, then it can be fully allowed. If now it's a now condition, now we need to apply that to this 4,300. If rupees 4,300 is improvement, above computation shall be made. That means this computation we have to make if it is the improvement. Then it's based on our decision on whether this capital nature, whether this improvement, or whether this, that means whether this enhances the value of the asset or not. Then based on the information given, now I am always, it's taken all the information from the given the adjustments, then it is given based on the information given, it has mentioned that the major repair, then it has mentioned it has done the major repair, then it's not the minor repair, it's a major repair. Then in that I have assumed it is from this repair, it's in the improvement side of it. Therefore assume that enhances the value of the building. Then I have taken this as the improvement. Okay, improvement, I have taken it as the improvement. It's based on the totally based on the assumption, based on the information provided in the question. Clear? Then under that, let me come to the current application. It's very clearly given, repair and improvement of building, purchase 2018-19, answer based on the IRA provision on no after 1st April 2021, relevant to the year of assessment 21-22. Okay, then the cost same, cumulative capital allowances. Then I'm coming for this after putting this assumption, after having this explanation, explaining the major repair and what is current application on repair. If it is improvement only, what we have to do, this is a definition, then only I am coming to this. Okay, then all the explanations given to you. Then less cumulative capital allowances claim. Now I am taking this to 21-22 because it's after provision. 18-19 we have provided the capital allowances for the year 20, 19-20 on the depreciation basis 19 years, 2021 on the depreciation basis 18 years. Then we have the cumulative capital allowances claim for these 2 years up to 2021. Then as at 31st March 2021 we have the tax written down value 29,750. Then our concern year of assessment is 21-22. Then what's the previous year, 2021? Then that's why this is important. Then from this 5% we need to take the maximum amount of the improvement expenses applicable under section 14. It is 1,488, which is from this tax written down value the 5%. What's the actual? Is the actual repair and improvement expense charged to income statement 4,300, disallowable improvement cost, and which should be added to the depreciation basis when we are computing the next year capital allowance is applicable. Then it's a disallowable 2,813. Let me come to the answer. Let me come to the answer here, which is the where it is repair and improvement, it is 2,813. This has done by adjusting to the 21-22 by elaborating changes happened to the year of assessment 21 and 22, and answer has modified accordingly, and particular earlier provision current provision, why it's applied like this. If it is repair, what we have to do, what's the definition of the improvement, everything provided to you, and after that I have taken the answer. Okay. Now come to next one, the repair and improvement, it has completed. Next one, several technical training sessions were conducted to improve the knowledge of the employees working in the marketing division, and the expenses for the same were included under the staff welfare. Now we have the staff welfare expenses in the paper, which is 3,420,000. It has included the training expenses incurred on behalf of the which is on the marketing division. Then this is incurred for the production of income training. It has included in the staff welfare. It's allowable deduction incurred for the production of income. That adjustment also completed. We are very close to the end of the question. Then the rupees 2.2 million was incurred for the maintenance work in relation to a private property owned by whom, Lamai? Owned by a director. Now we are in the EOSL, Equipped Office Solutions Private Limited. Can we include the private expenses of the director under the maintenance cost of the private property onto the director in the income statement of our company? No. This is what this is under section 197. This is a domestic expenditure. Then under section 10 subsection 1b, such kind of the domestic expenditure, what we have to do, should be disallowed. Now here the office maintenance 9,450. In this, the 2.2 million has included the domestic expenditure. Then in that, the domestic expenditure, let me come to the answer. The office maintenance of private property owned by a director, the domestic expenditure, it should be disallowed. It's under section 10, if not mistaken, section 10 subparagraph B. In that, I think first one, Roman 1 is on the domestic expenditure, which under the definition of the section 197, 2,200, it should be disallowable. It should be disallowable. Then it also done. What the next adjustment? Last few adjustment we have to do. Then the interest income received from foreign currency account amounting to rupees 11,600. What is this? This is exempted interest income. Interest income received through the foreign denominated or foreign currency, it is under third schedule, it is exempted. Then it has included in the interest income from fixed deposits. Let me come to that adjustment. The whatever it is, Lamai, entire finance income, this is from interest income from debenture. Second one, interest income from fixed deposit. Is this part of the business income or not? No. Is this effectively connected to the business? No. Then these two first, let me remove from the business income. Then this is what? This is the part of the investment income, interest income, part of the investment income, 36,286. Let me remove it. Then is that all? No. Let me take this under investment income, interest income. This is from fixed deposit. I have divided this into two components. One is on foreign currency denominated accounts. It is exempted. Where the exemption has given, it's given in the third schedule. And the LKR, it's a total in the question, it has given 36,000. 286, among that FD interest 35,636. Then from this 35,636, I need to reduce the exempt income 11,600. Then automatically liable interest is what's the amount? 24,036. Entire part completed. It's first removed from the business income, entire interest income, and it shall be identified under investment income under two components, interest income from FD and debenture also. Interest income from FD, I have divided it to liable interest income and the exempted interest income. Please do these things in your examination very clear manner to another person to identify very clearly what you have done. The entire part on that adjustment completed. Now let me come to last adjustment. ESC brought forward for the year of ESC brought forward to year of assessment 2021 amounting to rupees 6.9 million was reflected in the previous year's return of income of the company. Now previous year is the last year of the ESC, I mean previous year in this question, not in our previous year. Then in this question, previous year, which is 1920, it was the last year for the ESC. All of you all know ESC has abolished with effective from 31st December 2019. Then 1st Jan 2020 onwards, no ESC. Then it is in the question it has given previous year return. This has reflected. Then I have assumed that this has paid in the year of assessment 2019-20, then we can take it. Then EOSL has made advance income tax payments amounting to rupees 45 million. That's mean the quarterly installment payments 45 million. What are those two? These two for the tax credits, not for the business income. I'm coming to the taxable income which tax computation. Under that I am taking the tax credit. Economic service charge, Lamai, what is the carried forward limit of the ESC? Is it 2 years from the date of 2 years from the year paid year, then ESC. If I have adjusted to this for the year of assessment 21-22 for your testable year of assessment, ESC previous year return, that's mean in our case 1920. That's mean for that question tested year, then question එක අපිට test කරන්නේ in this question 2021. Then for that previous year mean 1920. I have not changed that. Then assume that paid in that year. That's mean 1920 is the last year which the ESC has effective. Then if it is has paid in 1920, then it can be carried forward with effective from 1st April 2016 onwards. ESC carried forward limit is 2 years. 2 years. Then if I have come to here, it's a paid year 1920, then it can be carried forward to 2021 and claim. If there is a balance, it can be carried forward to 21 and 22. This is the last year. Then I assume that this can be claimed in this our year 21-22 and it's paid in 1920. Then with that all the assumptions which I have explained to you, based on this lamai I have claimed the ESC. Without a basis I have not claimed anything. Then economic service charge 6.9 it has claimed, and the quarterly installment payments directly I have taken 45,000. Now typically all the adjustments completed, but let me come to the particular notes. From this onwards, let me come to particular notes. Entire things in the income statement, from that profit before tax we have taken, revenue you know, and the other income, rent income adjusted, dividend income adjusted, profit on sale of fixed asset adjusted, foreign service fee income adjusted, gain on sale of shares quoted in the Securities and Exchange Commission, gain from the listed shares we have not adjusted. This is part of the investment income, but even in the investment income this is exempted. Let me come to here. Gain on sale of listed shares not form part of the business income. It should be removed from the business income. Completed. Then when it comes to the investment income, in that the gain from realization of listed shares, it's exempted under third schedule, then nothing to be included under investment income. That also completed. Then all the other income we have considered. Extract of the certain expenses, remuneration, assume that incurred for the production of income, director fee, assume that incurred for the production of income, provision for retirement benefit obligation, it should be disallowed, 19,935. Then under business income, which is the provision for retirement benefit obligation RBO, it should be disallowed. Then the next one, bad and doubtful debts considered, provision for impairment of slow moving consumables and damaged stock should be disallowed, 23,500. It is provision for impairment of slow moving consumables and the damaged stock, it should be disallowed. Next one, CSR expenses adjusted, warranty provision adjusted are the depreciation and amortization, depreciation on the property, plant and equipment and intangible asset we have not adjusted. We should need to disallow with depreciation and amortization of PPE and intangible asset 210, 755 disallowed. Then fines and penalties we have done the adjustment, legal fees done, advertising and promotion done, stamp duty and consultancy fees done, repair and improvement completed, office maintenance completed, staff welfare completed. Entire note 3, all the adjustments completed. Finance expense, interest, lease interest, right of use lease asset completed, and the bank charges anyway allowable deduction, interest on loan, interest on overdraft, we need to go for the adjustment on this lamai. For this I am again taking the adjustment relevant to the 21-22. Then all of you all aware the application of the section 18, or rather that deductible amount of finance cost, it has now suspended only for the year of assessment 21-22. It's only for the year of assessment 21-22 with reference to the application of the 6th schedule. It has suspended when go for the thin capitalized or the restriction of the claiming of the finance cost. Then for the year of assessment 21-22, we only looking for the meeting of the requirement of the section 12, whether the finance cost has incurred for the production of income, or whether that finance cost has incurred for the borrowing, that borrowing has utilized for the acquired asset, which that asset used for the production of income. The section 12 particular subsection A and subsection B, we are looking for not other than that. Section 18, it's applicable for 22-23, for only for 21-22 it has restricted. And again there is a change for section 18. Earlier we had stated capital into stated capital plus reserves other than revaluation reserves into 3 or 4 times, but with the amendments with effective from 1st April 2021, it is only 4 times, and it has very clearly defined everything. But with this suspension or a suspending of this finance cost, then the application of the section 18 is not relevant for 21-22 only. Now come to this one, applied provision relevant to 21-22. application of the 6th schedule under temporary concession only for 21-22, therefore not apply the restriction under section 18. Assume that total finance cost has incurred for the production of income, hence allowable deduction. Then what I have done, I have applied only the provisions of the section 12. Section 12, okay. Then it's a, with that assumption and the adjustment, nothing to disallow. It's entire finance cost. Assume that it's satisfy the requirements under section 12, then it is an allowable deduction. Now what next? The finance income, everything I think we have considered. The interest income we have taken. Now last string, gratuity payment, come to the working for under the gratuity payment. That's only adjustment I think we have to do to complete the question. Then where is the gratuity adjustment? Gratuity, okay, it should be there. Okay, here computation of the gratuity, then it is opening, it's all of you are familiarized with this. Then balance, opening balance, provision for the year we have, remeasurement is in the OCI, it's a credit balance is there, then provision should be debited. Then the balance as at 31st March 2021 we need to take now. Come to the pre-seen is given in the that's why when doing the question lamai, pre-seen information also critical. The retirement benefit obligation for company, opening 76,336, for the closing for the company 2,949. There is a remeasurement in the OCI, in the other comprehensive income, the 10,521 is credited to the OCI. Then therefore it's a there, then under that the opening, closing, remeasurement adjusted, provision for the year, then payment made during the year, it is 2,801. Let me take the payment of the gratuity. It's a usual adjustment, and don't forget it's a usual adjustment in your exam paper. Okay, then what has happened? Gratuity, the payment, sorry, it has deleted. Then let me take the answer from here. The 2,801. Done. All the adjustments relevant to the business income, it has completed. All the adjustments relevant to investment income, it has completed. I think nothing to do. Then let me take the summation of the business. Let me complete the business income. Then here business income total, okay. The plus side total we have to take. Everything taken, done. Then plus side and the minus, then we are having the business income and assessable income from business 198,393, and there is the exempted business income which we have removed by taking the exempted service income and the expenses incurred for that service income, because I have done that under two adjustment. In the question it has not given the profit has included or not. Anyway, by doing so the profit has removed from the profit before tax. Then I have taken, we need to show this, then I have taken exempt business income. Assume that accounting profit equal to exempt business income. That's mean for the business purpose, sorry, the tax purpose and the accounting purpose, the same adjustment, no, nothing to do further adjustment with relevant to tax. Then I have taken with this assumption I have shown here. Then my liable business income 198,393. Let me come to the investment income. We have the liable dividend, we have the liable interest, and the total assessable income from investment, it is 92,682. Now all these two done. Now let me come to the taxable income. In the taxable income lamai, business income taken from the schedule, investment income taken from the schedule. We don't have the other income, like I have explained. I have done the adjustments as applicable relevant to year of assessment 21-22, not for the year of assessment given in the question. Okay, all the explanation provided. Then other income, it's nothing. Total assessable income is a summation of these three. Then the deduction from the assessable income, the qualifying payment to the government, this can be claimed up to the assessable income. Now you can see assessable income is high, qualifying payment is low, then we can claim the entire part. Then we have the total deduction is this. The taxable income is the assessable income minus the qualifying payment. Then we have the 286,779. Okay, then tax on taxable income I have not done in the phase. I have taken the separate sheet and done this. Let me come to this one. The calculation of the income tax liability, I think it's visible. Let me little bit increase this. And from here I have taken like this, assessable income from business. Now you know we have to apply the normal tax rate. Then in that we have the business income 198, 393 here, 198, 393, which is liable part. Then it is taxed at the rate of the 24 lamai. Then 24 is the higher tax rate. Either you can arrange the qualifying payment to business income, either you can arrange the qualifying payment to investment income, because both this income will be taxed at the higher tax rate. Then to give the benefit, the reduction you can do either one. Then I have taken the business income. Then my taxable income from business, it's a 194.93. The rate is 24%. Then tax liability is here. Then from the, this is a situation where we have the composite of the, that's mean taxable income will be taxed at the different tax rates. If we have the gain from the realization of an investment asset, then in that context also we need to take this under the 10% by under investment income. Then this is the situation where taxable income will be taxed at the different tax rates. Then on interest income from fixed deposit, we don't have the any other. Then in that I have divided to dividend income and interest income. Why I have done so, Lamai? The interest income and rent, if there is a rent income, anything, it will be taxed at the 24%, but dividend income of a company, the gains from the dividend, it will be taxed at the rate of what? 14% subject to exemptions. Then interest income at the rate of the 24%, dividend income at the rate of the 14%, and my total income tax liability, it goes to 62,027. Then taxable income, that particular part also completed. I am not telling you to do a separate schedule, even the phase of the tax computation based on your time availability, please do, but properly show how you have applied the tax rate. It's essential. Properly show how you have applied the tax rates differently and the application of the qualifying payments, and that should be properly shown. Then this is my tax on taxable income, or rather my tax liability. From this I need to take the tax credit lamai, ESC and the quarterly installment payment, and the balance tax payable or refund due, the 10,127. Okay. Then this is the end of the discussion of the December 2021 question 1 part A. What I have done, I have adjusted this to your the 21-22 year of assessment, taking the relevant changes under amended Act number the 10 of 2021 of the Inland Revenue Act, then done the adjustment, all the relevant adjustment what I have done, explanation separately provided, assumptions provided, calculations given. Okay. Then let me wind up this part A discussion of the question 1. Please go through, please practice, then this is one of the good question for you to earn marks. When doing this question, time management is critical. Okay, let me wind up this question and answer discussion. Thank you.